Let's get to our top story now. Joining us is Evan Lucas, a chief market strategist at InvestSMART. Evan, perhaps unsurprising, there was a 100% chance, according to observers, that the Fed Reserve was going to cut rates this morning. It did. What does it mean for us?
Yeah, so you're right, it did, and just sort of, I'm just going to nerd out a little bit for you here, Laura, with regards to sort of
we're doing it anyway.
Stats. So, so it's been 3,869 days. It's the second longest period in the Fed's history. You have to go back to February 1942 to March 1954 for the last one to actually see a period where the Fed hasn't cut rates like they just did. So it is an extraordinary thing. They also did something that was probably not really talked about as much as it should be, which is that they've actually stopped what's referred to as quantitative tightening, where they were actually selling the bonds they bought during their QE period, so their quantitative easing period post the GFC. All of that has stopped as well. But you're right, they've cut interest rates. What does it mean for us? It's just several ways of looking at it. So first way, you've got to look at it from a state's perspective. The US is actually in a very interesting position. So they are in a very, I'd actually even argue, strong economic position. They have some of the lowest unemployment in the last 50 years. They have growth that's just on or above trend at the moment. If you have a look at their overall wealth scenario, it is well and truly ahead of where it was just before the GFC. They haven't reached inflation. That's their mandate is 2%, so that gives the Fed a bit of space. But what happened and what it means for us is it releases a little bit of economic pressure. There it's clear that the US-China trade war has started to play out in other data. So yesterday we've got Chinese manufacturing, we got China's service numbers, and they are slowing down. We also got overnight European numbers that are on the manufacturing side that is, again, affected by this because we know there is a possibility of a European tariff of some description, but also most steel production goes towards Europe, towards their car makers and so on and so forth, and they too are contracting. So if you see a cut from the Fed, it's actually twofold. It's not just for a domestic front, it goes global. Everything that basically looks at in a base currency is in US dollars. If we want inflation globally, US dollars actually need to fall to actually see some form of price inflation. So the Fed is a little bit different to everywhere else because they also control, to some extent, global inflation, and a high US dollar, which is what it's been over the last 18 months, is starting to hurt. Trade wars are starting to hurt. There's no doubt about that. But overall, it's very interesting because what the market didn't like is the fact that they only cut by 25 basis points, and Powell used statements that suggested that it may actually be a very small cycle, as in a small rate-cutting cycle. So he alluded to the fact that this is more likely a mid-cycle cut rather than a lengthy, long-term downward trend. Certainly didn't go well with the president.
Yeah, well, he wanted that cut to be reduced by 50 basis points, right? And so perhaps now he'll be putting pressure on there to be an eventual cut, another one.
Yeah, so this is the interesting thing about it, Peter, is that he's the first president basically in the post-war era to really put political pressure on the Fed. They are normally seen as sort of untouchable. You don't really go there on either side of politics has really never really touched them, but obviously he is a different president. He does his things his way, and he does. And he's already tweeted, quite a lengthy thing that alludes to several things that he's been talking about for the last 6 months. He's basically implying that the European Union and China is manipulating their market, manipulating their currency by cutting rates, and that the Fed is leaving the US behind and that they're losing because of it, and he's doing all of the work. He is, and very strong in his idea that we wanted 50 cuts today and a lengthy cutting process. He basically wants the federal funds rate back to 1%. It's currently at 2 to 2.25 after what happened last night. The market is still pricing that they will probably cut rates over the next 12 months to about 1.5. So there is still 3 to come. So who's right is an interesting question. The market still believes it's coming. It just might be a very slow process, not as fast as what the president hopes.
I'm really interested to delve a little bit deeper into what you said about China and a few worrying signs there. But that, in the recent past, has been pretty good for Australia because if, the Chinese economy is slowing somewhat, it means the government there has been throwing stimulus at the economy, and therefore it's really benefited Australia, hasn't it?
Yes, it has, and that is still happening very, very much so. So you're dead right, Laura. And the way to look at it is the unbelievable elevation still in iron ore. Iron ore is it's still above 115 US a tonne. It's about 119 as of last night. It's averaging around about 107 for 2019. The expectation from most analysts is for it to be about 75. So that is a huge difference. Copper is also doing much, much better. And that, as you said, comes down to the fact that the PBOC, so the People's Bank of China, along with the Beijing government, are doing measures that we have seen a lot in the past, particularly during the early 2000s, which is that they are basically putting money back into the economy and releasing policy to allow them to actually therefore expand.
All right, Evan Lucas, thank you.